Welcome to our channel, where we dive deep into the strategies that can transform your financial future. Today, we're exploring the wisdom of Robert Kiyosaki, a mastermind in financial education and the best-selling author of Rich Dad, Poor Dad. In this video, we'll unpack the 6 basic rules of investing that he champions, guidelines that are designed to elevate your investment savvy and secure your financial independence. Whether you're a seasoned investor or just starting out, these principles will provide you with a solid foundation to grow your wealth effectively. Stay tuned as we reveal how mastering these rules can lead to lasting financial success. Rule 1. The importance of financial education. Robert Kiyosaki has long argued that true financial acumen isn't just about accumulating money. It's about cultivating deep financial knowledge. This distinction is crucial, as financial education lays the groundwork for making informed decisions that not only protect but also grow your wealth over time. Kiyosaki believes that without a solid understanding of finance, any money accrued can quickly dissipate through poor management and missed opportunities. Financial education empowers individuals by enabling them to distinguish good investments from poor ones, understand market cycles, and implement strategies that mitigate risk. It's about learning to make your money work for you, rather than working endlessly for money. This shift in mindset from passive earnings to active wealth creation is what sets successful investors apart. Kiyosaki stresses that financial literacy should encompass a variety of key areas, including understanding basic accounting, grasping the principles of investment, recognizing the importance of asset allocation, and knowing the tax implications of your financial decisions. This knowledge enables investors to create a robust financial plan that can withstand economic fluctuations and capitalize on opportunities as they arise. Read widely, dive into books about personal finance, investment strategies, and economic theories. Kiyosaki's own Rich Dad, Poor Dad is a great starting point that emphasizes learning about money management in ways that traditional schooling often does not provide. Take courses. Many online platforms offer courses ranging from beginner to advanced levels in finance and investing. These can provide structured learning and help demystify complex financial concepts. Follow financial news. Regularly engaging with financial news can help you stay informed about market trends and economic insights that could impact your investments. Join investment communities. Participating in forums and social media groups can provide support and insights from more experienced investors, which can be invaluable in practical learning. By prioritizing financial education, individuals set themselves up not just for occasional gains, but for sustained financial success. Robert Kiyosaki's teachings encourage us to view investment not as a gamble, but as a calculated and educated approach to financial freedom. Rule 2. Understand the difference between assets and liabilities. Understanding the difference between assets and liabilities is fundamental to navigating the world of investing, a concept Robert Kiyosaki emphasizes repeatedly in his teachings. Simply put, an asset is something that puts money into your pocket, whereas a liability takes money out. This distinction is crucial for anyone looking to build wealth effectively. Assets include investments like real estate properties that generate rental income, stocks that pay dividends, bonds that yield interest, and businesses that produce profit. These are the cornerstones of wealth building because they generate ongoing income, appreciate in value over time, and can provide tax advantages. For example, owning a rental property not only provides monthly income from tenants but also appreciates in value, offering a dual return on investment. On the other hand, liabilities include things like your personal residence, if it costs you more in mortgage and maintenance than it generates, car loans, credit card debt, or any other financial obligation that drains your resources. While a home can be considered an asset due to potential appreciation, Kiyosaki classifies it as a liability if the outgoings to maintain it surpass any financial gains. This is because the true cost of home ownership includes property taxes, maintenance, and interest on the mortgage, which can outweigh the appreciation value, especially in the short to medium term. The impact of understanding and applying this distinction can be profound. Investors who accumulate assets build streams of passive income that increase their wealth without additional daily effort. Conversely, those burdened by liabilities find themselves in a constant battle to make ends meet, often stuck in the dreaded rat race. To improve your financial health, Kiyosaki advises shifting focus from acquiring liabilities to accumulating assets. Start by evaluating your personal finances to distinguish your assets from your liabilities. Consider converting disposable income into investment in assets, and minimize expenses tied to liabilities. This strategic shift is essential for moving from merely managing finances to actively growing your wealth. Rule 3. The power of building and maintaining income-generating assets. Income-generating assets are the linchpin of a successful investment strategy, crucial for building wealth over time. These assets do more than appreciate in value, they actively contribute to your income, providing cash flow that can support and enhance your financial stability. Robert Kiyosaki champions these assets as the foundation for financial freedom and independence. Real estate. Investment properties can generate consistent rental income, which not only covers the property's expenses but also provides profit on top. For instance, purchasing a duplex where you live in one unit and rent out the other can be a smart way to reduce your own living expenses while the rental income pays down the mortgage. Stocks. Dividend-paying stocks provide shareholders with regular payouts, often quarterly, which can be reinvested to compound returns or used as part of a cash flow strategy. A well-chosen portfolio of these stocks can serve as a robust source of passive income. Bonds. Government and corporate bonds yield interest payments at fixed intervals, representing a predictable income stream. Bonds are often considered lower risk than stocks, appealing to those who prefer stability in their investment income. The benefits of these assets extend beyond mere income. For example, consider the case of Sarah, who invested in a small apartment building. The rental income from this property not only covers all associated costs, like maintenance and mortgage payments, but also nets a significant monthly profit. This extra income allowed Sarah to reinvest in additional properties, accelerating her wealth-building process. Investing in income-generating assets also provides tax advantages. Real estate investors, for example, can benefit from deductions like depreciation, mortgage interest, and other operational expenses, which can significantly reduce their tax liability. Incorporating income-generating assets into your portfolio means you are not just banking on the hope of selling an asset for a higher price in the future. Instead, you're creating a steady, reliable stream of income that can grow over time, cushion against financial downturns, and provide the means to further expand your investment horizons. This approach underpins a robust investment strategy that can sustain financial growth and stability long-term. Rule 4. Know how to use debt wisely. Robert Kiyosaki's approach to investing significantly revolves around the strategic use of debt. He differentiates between good debt and bad debt, concepts that are essential to understanding how debt can act as a powerful investment tool rather than just a financial burden. Good debt is used to purchase income-generating assets that not only cover the cost of the debt, but also provide additional income and potential asset appreciation. This type of debt leverages other people's money to increase one's own returns without requiring substantial initial capital. For example, taking out a mortgage to buy a rental property that generates monthly rental income higher than the mortgage and maintenance costs is considered good debt. This arrangement not only pays for itself but also contributes extra cash each month and potentially increases in value. Bad debt, on the other hand, involves borrowing money to acquire depreciating assets or to fund lifestyle expenses. This type of debt includes high-interest credit card debt used for buying consumables or luxury items that lose value over time. Such debt drains financial resources and contributes to a negative cash flow, hindering financial growth. A practical example of using good debt effectively can be seen in the case of an investor who purchases commercial real estate using a bank loan. The property is then leased to reliable tenants who generate regular, robust rental income. The income from the leases exceeds the monthly loan repayments and operational costs, allowing the investor not only to service the debt but also to profit from the venture. Over time, as the principal on the loan is paid down and the property potentially appreciates in value, the investor's equity in the property grows substantially. By understanding and utilizing the concept of good debt, investors can significantly enhance their portfolios. This strategic borrowing allows them to amplify their purchasing power and accelerate their wealth accumulation, demonstrating Kiyosaki's principle that debt can indeed be a double-edged sword, destructive when used carelessly but incredibly beneficial when wielded with precision. Rule 5. Create and protect your money. Creating and protecting your money are critical components of any sound investment strategy. Principles heavily advocated by Robert Kiyosaki. While building wealth is important, ensuring it is safeguarded against potential risks is equally vital. Here are key strategies for protecting your investments. Diversification. One of the most fundamental ways to protect your investments is through diversification. This involves spreading your investments across various asset classes, like stocks, bonds, real estate, and even different industries or geographical locations, to mitigate risk. The idea is that if one sector performs poorly, the others might balance it out, reducing potential losses. For instance, an investor might combine dividend stocks, government bonds, and rental properties in their portfolio to create a mix of steady income and growth opportunities while buffering against market volatility. Legal protection. Legally protecting assets is another crucial aspect. This can include setting up legal entities such as limited liability companies, LLCs, or trusts to hold assets. These structures can provide a shield against personal liability, meaning in the case of a lawsuit or debt collection, your personal assets remain protected. Additionally, such entities can offer tax advantages that further protect and maximize your investment returns. Insurance. Insurance is another layer of protection, particularly for real estate and other substantial investments. For example, landlord insurance on rental properties can cover property damage, lost rental income, and liability in the event of accidents or lawsuits involving tenants. Strategic planning. Regularly reviewing and adjusting your investment strategy is essential to navigate the complexities of market changes and economic fluctuations. This includes keeping informed about tax laws, market trends, and other financial regulations that could impact your investments. Navigating these complexities requires ongoing education and sometimes professional advice. Investors should consider consulting with financial advisors, tax professionals, and legal experts to tailor their investment and protection strategies effectively. By employing these protective measures, investors can not only grow but also shield their wealth, ensuring long-term financial stability and peace of mind. Rule 6. The need to give back. True wealth involves more than just accumulating assets and capital. It also entails a responsibility to contribute to society. The need to give back is not just a moral or ethical consideration, but a strategic component of a well-rounded wealth-building philosophy. Personal benefits. From a personal standpoint, giving back can enrich the giver's life by fostering a sense of purpose and fulfillment. Engaging in philanthropy can lead to personal growth, happiness, and satisfaction that often surpasses what financial wealth alone can provide. Additionally, philanthropy can help in building a positive reputation, which in business can translate to trust and loyalty among customers and partners. This aspect of social capital can be invaluable, especially when navigating complex network-dependent markets. Societal benefits. On a societal level, philanthropy plays a critical role in addressing social, environmental, and economic issues that may not be sufficiently addressed by the private sector or governmental bodies. By contributing to or establishing foundations, scholarships, or charitable endeavors, wealthy individuals and investors can create significant impacts in communities. These actions can lead to improved living conditions, better education and health care, and economic opportunities for underprivileged populations. Moreover, Kiyosaki points out that philanthropy can also lead to indirect economic benefits for the donor. For example, businesses that engage in community service or charitable giving often enjoy enhanced consumer perception, which can lead to increased sales and business opportunities. Furthermore, there are also tax benefits associated with charitable donations, which can be strategically used to optimize financial outcomes. In essence, the act of giving back is integral to the concept of sustainable wealth. It ensures that as one's wealth grows, it does so with a broader purpose that benefits not just the individual but the community at large. This philosophy not only cultivates a legacy of generosity but also supports a stable, healthy economy that can continue to prosper. In Kiyosaki's view, wealth is not merely a personal achievement, but a resource that, when wisely managed and shared, can foster long-term societal improvements. By integrating these principles into your financial strategy, you can not only enhance your wealth but also ensure its longevity and relevance. Remember to subscribe to our channel for more insights that can help you navigate your financial journey. Apply these rules and start building a richer future today.